Hello, beautiful team. How are you? I hope you are doing fine wherever you are. My name is Jerry, Jerry Mtunkulu. I am an ACCA fellow, and this is our week 3, ladies and gentlemen, as I'll be taking you through the ACCA Financial Management paper, the ACCA F9. And for those who are doing the ACCA Foundations in Financial Management paper again, who are doing the CAT, they are welcome as well. All right, so we've covered 2 critical topics. The first week, we covered the introduction to financial management, where we were introduced to this important subject area, and then we ventured into working capital management, where we looked at the 4 parts of the 5-part series in working capital management, where we looked at the general, we looked at general working capital management. All right, this was week 2. All right, and we also looked at inventory management or inventory control. Then we looked at receivables and payables. These are the 4 areas: payables management. Okay, now this is the last segment in the working capital series, where we are going to look at cash. We all know and appreciate that without cash, even a successful business or company is bound to fail. Cash is the lifeline, is the lifeblood of a business. Without it, the business is going to close. So, as finance managers, we are required to manage cash, hence financial management. All right, so as part of our focus, we need to tell ourselves that profit and cash are 2 different things. All right, like I said, a business might be profitable, but you'll be shocked to hear that they are closing shop. Why? Because although they were, trading very, very well, they failed to manage the aspect of cash. Okay? So, here are the difference between profit and cash. Okay, let us look at the differences. Now, 1, not all cash receipts affect the statement of profit or loss and other comprehensive income. I'm sorry for the omission there. And other comprehensive income. This is the statement of comprehensive income, or let me just say the profit or loss statement, the P&L statement, where we calculate our profit, right? So we need to understand that not all cash receipts are going to enter into this particular statement. So this is why we also say that profit and cash are different things. They are 2 different things. All right. For example, if we issue new shares, all right, this transaction is not going to impact our profit, okay, but it will impact our equity. It impacts our capital, which is something that is going to be recorded in the statement of changes in equity, statement of changes in equity, or the statement of financial position. These are the 2 statements that are going to be affected. Yes, in terms of cash flow, we are going to record that in the statement of cash flows. But the statement of profit or loss is not going to be affected. All right, so in that case, they are different. The other difference emanates from the fact that not all cash payments affect the statement of profit or loss. Okay. Here, if we are looking at the purchase of non-current assets, even if the cash has left the business, it is not going to affect the profit. But the statements that are going to be affected are the statement of cash flows and the statement of financial position. While that information is not relevant it's not necessary for you for now, but you need to appreciate what will be happening in the background. The other point we need to talk about is difference number 3. Some items in the statement of profit or loss are not cash flows. For example, depreciation, yes, or amortization. These items are subject to accounting conventions. All right, they are just mere, assumptions. Right, they are as a result of accounting assumptions, and they do not impact cash flows. Right, so but they've got a bearing in terms of affecting the profit or loss of the company, all right, but they do not impact cash. All right, so that's the difference. They affect the profit but not the cash flows. All right, this is why when we are calculating or when we are computing cash flows, we then have to add them back. Okay, the depreciation or amortization is added back. All right, but if it is a gain, we deduct it, all right, in the computation of cash flows from operating activities. All right, lastly, there is this difference. The timing of cash receivables and payments may not coincide with statement of profit or loss recording. For example, sales and receipts from receivables. All right, we are simply saying that when we are recording a sale, we record it on the date of the sale, but the payment for that sale might be sometime later. All right, so let's say you sold something for 1 million on 31st of December, which is the year end. You need to record that sale, but doesn't mean that in your cash flow the sale is going to impact the cash balances. All right, you'll discover that in your cash flow that sale is not going to be there. Why? Because the receivables will be paid maybe sometime next year, February. All right, so that's the aspect of the profit versus cash flow. Let's move on. Now, the question that comes is, why on earth do we have to hold cash? So there are 3 main reasons or motives why businesses keep cash. The first motive is the transaction motive. This is the idea that we need to have cash in our safe so that we'll be able to pay our bills as they fall due, to pay bills, to pay salaries, etc., or other utilities. All right, so for us to be able to do some transactions, we need to have cash on our side. Then the second motive is the precautionary motive. Sometimes, even if when things are hard or when they are good, we shouldn't, utilize all the cash. Why? Because we will limit ourselves in terms of any eventualities. All right. So we need to be on the safe side. We don't have to use it all up. Okay. We need to be just on the safe side. To be just on the safe side. Okay. We need to prevent ourselves from erratic, situations or erratic demands, which might cause us to need cash. So to remain safe, we just have to keep some balance on the side. Right? This will also help us to respond to any situation as it come by. Then the speculative motive. This one is the motive that we need to have cash so that when some favorable opportunity come by, we'll be able to participate in. All right. For example, we are anticipating that maybe if we keep our foreign currency today, the rate is going to move in our favor if we transact maybe after 2 months, and that foreign currency would have yielded more profit. So in that case, we are speculative. All right. So it's an aspect of anticipating some favorable future to occur. So we tell ourselves that it is better to keep our cash today for some months, then we'll dispose of it. Maybe we would have accrued some benefit. Okay. How to deal with cash shortages? How do you deal with cash shortages? The first idea is to reduce inventories. Okay, because if you continue keeping a lot of inventories, it means you will be eating on your cash budget. So you need to reduce your inventories, because to keep those inventories, you need a security guard, you need refrigerators, you need cold rooms, all those things, good warehouses in which you have to pay some insurance premiums to pay, all those things. So you need to reduce your inventories. You can as well deal with cash shortages by deferring capital expenditure. Yes, this one is a good motive. However, it won't sound well if it is going to impact the competitiveness of the business, because if customers then come to your shops and they see them very old and renovated, all those things, they are going to be worried, and by the end of the day, management would be the ones to be blamed. Defer or reduce dividends. Okay, the dividend theories. All right. Now, this one might be good in the eyes of management because they need to have the cash to enable the business to continue running. However, shareholders might be annoyed if you do not pay them their dividends in time. So if you continue delaying or postponing dividends, you might frustrate the shareholders, and they might end up, selling their shares en masse, and that will send a bad signal to the market. Is that clear? Then chase receivables to pay earlier. Yes, you need to have a good credit department. The receivables management department, who are going to chase after your debtors so that they pay early, right? By so doing, if they pay early, then you're going to have some cash flows. You need to postpone the payment of payables. Yes, this one's a good idea. However, you need to tell the examiners that, however, that might affect your relationships with your potential suppliers or current suppliers, who might find you as not a good business to deal with. All right, so you need to be careful there. Use short-term borrowing. Yes, sometimes we can use overdraft, provided our financiers, are willing to give us such a facility. We can use overdraft. However, overdraft rates are high. Okay, you need to point out that overdraft rates are usually very, very high, and the money is paid upon demand. So this is why if you took an overdraft, the moment your cash deposits are made, the bank will first of all take their overdraft and then leave you with the extra. Okay. You need also to sell extra assets. Those assets which are just idle and are not in use, you need to sell them. Then lastly, you can arrange for a sale and leaseback, right? let me just explain this